Play the auction, not the emotion. Follow volume, follow truth. Smart money moves first. Trade where the banks trade. Smart money futures.
A lot of traders lose money on breakouts for one simple reason. They assume every move out of a short-term range is real initiative. A lot of the time, it is not. It is just inventory correction. And if you do not know the difference, you end up buying the high of a balancing market or selling the low of a balancing market, only to watch price rotate right back through your entry. In this video, I want to give you 3 signs that a breakout is probably just inventory correction, not true initiative activity. We'll frame it through auction logic. We'll use practical examples in NQ and ES. And we'll talk about what this changes for your entry, your invalidation, and your targets. Because in professional execution, the goal is not to predict the breakout. The goal is to understand whether the auction is actually repricing into a new area of value or just cleaning up inventory before rotating back. And that distinction matters. Before we get into the 3 signs, we need to define inventory correction properly. Inventory correction is not the same thing as initiative buying or selling. It is not strong participation repricing the market into a new area. Usually it is shorter-term positioning, getting too stretched in one direction, and then unwinding. That unwind can look aggressive in the moment. It can break a local high. It can squeeze shorts. It can run stops. It can print fast candles. And still, it may not be a real breakout. Why? Because the underlying auction has not actually changed. Value has not migrated in a meaningful way. The move is often mechanical, not structural. This is one of the biggest mistakes traders make. They confuse speed with conviction. They confuse a stop run with acceptance. They confuse movement with edge. But markets are auctions. And in an auction, price can move sharply without actually being accepted at those prices. That is the key idea. A market can probe higher because shorts are trapped, because inventory was leaning too short, because local traders are forced to cover. But unless higher prices are accepted, unless value begins to build there, unless participants continue doing business there, that move can fail very quickly. So the question is not, did price break out? The real question is, who is behind the move? And is the market accepting the new area? That is what separates inventory correction from true initiative. Sign number 1. The first sign is this: the market breaks structure, but does not build acceptance. This is one of the cleanest tells. You get the visual breakout, but not the auction confirmation. So what does that look like in practice? Let's say ES is balancing through the morning. You have a clear intraday range. Price has tested the upper edge once or twice already. Then later in the session, price pushes above that upper extreme. Breakout traders pile in, stops above the range get triggered, momentum candles appear, but a few minutes later, price cannot hold above that area. Volume does not really build there. You do not see sustained trade above the level. The market does not start using that higher area as fair value. Instead, it slips right back into the prior range. That is a major sign the move was inventory correction, not true initiative buying. Because real breakouts tend to show some form of acceptance. That does not mean the market has to trend in a straight line. And it does not mean there cannot be a retest. But it does mean the auction should begin doing business outside the old range. You should see evidence that participants are willing to transact there, not just run through it. This is where concepts like value area, volume profile, and time spent become very useful. If price probes outside balance but cannot hold outside value, that matters. If the market explores higher and quickly returns to prior value, that matters. If there is no meaningful development in the new area, that matters. The breakout is weak unless the auction accepts it. And this is exactly why chasing the first extension through an obvious level is often poor trade location. Because your idea might be breakout, but your actual location is at the edge of a move that has not proven acceptance yet. That is not professional asymmetry. Professional execution is usually waiting for one of two things: either clean acceptance outside the range, and then using a retest for continuation, or rejection outside the range, and then using the failed breakout as a trade back into value. Those are two very different trades, but both are higher quality than blindly buying the first print through resistance. The common mistake here is simple. Traders see the level break and assume the auction has changed. But structure is not confirmed by the break alone. Structure is confirmed by what happens after the break. That is the distinction. Sign number 2. The second sign is context. A breakout is more likely to be inventory correction when it happens after the market has already become too one-sided in the short term. This matters around opens. After trend mornings and after emotional late session moves, here's the logic. If shorter-term traders have gotten heavily short into the low or heavily long into the high, the market often does not need fresh higher time frame participation to move the other way. It just needs those weak hands to get squeezed. That squeeze can look strong, but it is still different from genuine initiative participation. For example, imagine NQ opens weak and sells off early. Everyone starts leaning short. Delta is negative. Momentum traders are pressing. The market becomes emotionally positioned in one direction. Then price stops going lower. That alone is information. Next, the market starts lifting. Shorts begin covering. And the move accelerates through local resistance. A lot of traders interpret that as bullish breakout confirmation. But from an auction perspective, you have to ask whether this is actual new buying or just short inventory correcting after getting too stretched. That is a different event. One of the best clues is how the move began. Did the market first fail to continue lower from a structurally important location? Did selling dry up at the extreme? Did the move begin with trapped inventory rather than fresh acceptance higher? Did it reclaim a poor low, a session low, VWAP, or a local LVN, mainly through short covering? If so, you need to be careful about calling it a real breakout. Inventory correction often begins with discomfort, not conviction. It starts because one side cannot continue, not because the other side has clearly taken control of value. This is subtle, but critical. The market may rally sharply simply because the short side is wrong, not because the long side is right in a bigger structural sense. And if you do not understand that, you will overestimate the quality of the move. This is why context always comes before pattern. A breakout candle means very little by itself. What matters is what the market was doing before that breakout. Was the auction balanced and then accepted a new area? Or was the market too short, too emotional, too extended, and now forced to correct? Those are not the same thing. The professional read here is simple. When one-sided inventory is driving the move, be careful about paying up late. The better opportunity is often not to chase the squeeze, but to evaluate whether the move can actually migrate value. If not, the market often rotates back once the correction is complete. Sign number 3. The third sign is target quality. A breakout is often just inventory correction when it does not have a clean structural path to meaningful target magnets. This is where a lot of traders get trapped by ideas that sound good, but do not offer real asymmetry. A valid breakout should not only have confirmation, it should also have room. There should be a logical destination that makes the trade worth taking. Maybe that is the next LVN, a prior session high, a composite edge, an unfinished auction reference, an HVN migration zone, or a higher time frame value area edge. But if the breakout is pushing directly into overhead structure, into prior acceptance, into a high volume node, or into a thick area of recent trade, then the path is not clean. And when the path is not clean, a lot of those moves stall out because they were never true repricing events to begin with. They were just local inventory adjustments. On the surface, that sounds bullish, but directly overhead, you have yesterday's value high, a composite HVN, and a prior failed auction area where the market previously found heavy two-way trade. That is not a clean path. That is traffic. And traffic reduces asymmetry. In that situation, even if the breakout extends a bit, it is vulnerable to stall and rotate because there is no open auction above. There is no vacuum. There is no clean imbalance path. This matters because professionals do not just ask whether a trade can work. They ask whether the structure supports efficient movement. That is a different standard. Low-quality breakouts often happen in the middle of larger structure. They break one local level, but they are still trapped inside a broader zone of acceptance. That is why they feel promising at first, and then die. The market is not actually escaping value. It is still inside a larger auction. And that is exactly the environment where inventory correction can fool you. A little squeeze, a little extension, then rotation. So before taking any breakout, ask this. If this move is real, where should it go? What is the logical target magnet? Is there a clean path there? Or is price just pushing from one messy area into another messy area? If the answer is messy to messy, that is usually not A+ trade location. Putting the three signs together. So let's tighten this up into a practical framework. A breakout is more likely to be inventory correction when these three things show up together. Number 1, price breaks the level, but cannot build acceptance outside the range. Number 2, the move comes after short-term inventory got too one-sided and is likely being forced to unwind. Number 3, the move has no clean structural path to meaningful targets and is pushing into nearby overhead or underlying traffic. When these line up, you should become very skeptical of the breakout narrative. Not emotional, not biased, just skeptical. Because the market may still move a little further. That is always possible. But the odds of sustained continuation are lower, and the risk of rotational failure is much higher. That is the key. You are not trying to prove the breakout impossible. You're trying to avoid paying for low-quality auctions. That is a very different mindset. Example. Let's walk through a realistic NQ example. NQ opens inside prior value and trades relatively balanced through the first part of the session. Early selling pushes into the lower part of the range, but it does not get real continuation. Sellers cannot extend cleanly. The market stabilizes and begins rotating back toward the center. Now short-term traders start leaning short because they expected the early weakness to continue. As price reclaims VWAP and pushes toward the upper edge of the intraday range, those shorts get uncomfortable. Then NQ pops through the range high. Breakout traders buy it, stops above the high trigger, the tape looks fast, and people start calling it initiative buyers taking control. But step back and apply the framework. Did the market build acceptance above the breakout area? Not really. Did the move begin after inventory got too short and could not continue lower? Yes. Did the breakout have a clean path higher? Maybe not. Maybe directly above sits prior day value high and a composite HVN. Now the read changes. Instead of assuming trend continuation, you recognize the move may just be inventory correction into overhead structure. So what does that do for execution? It tells you not to chase the initial breakout. Instead, you watch the response. If price cannot hold above the prior range high and order flow starts drying up or failing to attract continuation, that failed acceptance becomes the setup. Now your location improves dramatically. You are no longer buying emotional expansion. You are assessing whether the auction rejected higher prices and rotated back into value. Your invalidation becomes structural, above the failed acceptance zone. Your target becomes logical, back toward the range midpoint, VWAP, POC, or the opposite side of value, depending on context. That is a completely different trade than breakout chasing, and usually a much better one. What professionals look for instead? So if you should not automatically chase these breakouts, what should you look for instead? Professionals usually want one of two outcomes. The first is real acceptance. That means the market gets outside the prior area and actually starts doing business there. It holds the new area, it retests intelligently, and it shows continuation from accepted price rather than emotional extension. That is stronger. The second is failed auction logic. That means the market probes outside balance, fails to attract continued participation, and returns back into value. That failure becomes information. The rejection itself becomes the setup. Both approaches respect the auction. Both approaches wait for confirmation. And both are built around structure, not impulse. That is the standard serious traders need to adopt, because breakout trading is not the problem. Blind breakout trading is the problem. The issue is not taking expansion trades. The issue is taking them without understanding whether the move is true initiative or just inventory cleanup. When not to trade the breakout, there are a few moments where you should be especially cautious. One is late in a balanced session, when the market has spent most of the day rotating and then suddenly pokes an extreme without clear acceptance. Another is after an emotional open drive that stalls and snaps back. Another is when the breakout occurs directly into obvious higher time frame references. And another is when you cannot identify a clean invalidation beyond the idea that it should just keep going. That is not enough. Your invalidation must be structural. If you are buying a breakout and the only reason you are wrong is that momentum slowed down, you do not have a good trade. You need a structural reason the idea fails. Without that, you are trading excitement, not edge. Summary. So let's close it out. A breakout is often just inventory correction when it breaks structure, but does not build acceptance. When it happens after the market becomes too one-sided in the short term, and when it lacks a clean structural path to meaningful target magnets, that framework will help you stop confusing stop runs with strength, speed with acceptance, and movement with opportunity. Remember, markets are auctions. Price can move outside balance without being accepted outside balance. And if there is no acceptance, the move is often vulnerable to fail back into value. That is why trade location matters more than trade idea. That is why confirmation matters more than prediction. And that is why serious execution starts with understanding the quality of the auction, not chasing the appearance of momentum. If you want a deeper framework for reading acceptance, rejection, failed auctions, value migration, and how to turn that into actual entries, invalidations, and targets in NQ, ES, and MES, that is exactly what I built into Trading on the Edge. The book is designed to work with the free content on this channel. It is the full operating model behind the framework, and it was written as the intentional alternative to an expensive futures trading course. So use the channel for application, use the book for depth, and study them together. And if this video helps sharpen how you read breakouts, the next concept you should study is failed auction logic, and how rejection at extremes can produce the highest quality rotational trades.